Why do we adjust for pensions and post-retirement obligations? These are mainly healthcare obligations, which are also commonly referred to as other post-employment benefits, or OPEBs. In simple terms, defined benefit pension and OPEB plans represent benefits that are earned by employees while they are employed, but paid after those employees retire. Certainly, these are legal obligations in the case of pensions and economic obligations in the case of OPEBs. They are common across many corporate sectors, particularly industrial sectors. What are credit-adjusted financials? Well, financial statements and disclosures are the starting point of our financial risk analysis. However, an important part of our ratings process involves making analytical adjustments to those amounts that are reported. And adjusted numbers provide clarity into our analytical thinking as we try to get at the underlying economics. Consistency by normalizing different accounting conventions such as US GAAP and IFRS. And comparability by enhancing period over period and entity to entity comparisons. Okay, so what are pensions and OPEBs, and why do we adjust for them? Well, as mentioned, these are benefits that are earned while employees work for the company, but are paid upon retirement. In other words, they are essentially a form of deferred compensation, whereby employees accept a portion of their compensation on a deferred basis, and therefore become creditors of their own companies via the plans. They also represent a call on future cash flows of the company. Ultimately, these obligations will be settled in cash, very much like a typical bond would. And to the extent that they're underfunded, we consider them debt-like in our analysis based upon the projected benefit obligation, or the PBO, for pensions, and accumulated post-retirement benefit obligations, the APBO, for OPEBs. And these are simply accounting conventions which also reflect how they show up on a company's balance sheet. Now, we do call them debt-like because we recognize that there are many measurement uncertainties with recording these obligations. Things like discount rates, inflation, employee turnover have a significant effect on the measurement. So that's why they're called debt-like. It's important to point out that while we adjust leverage, profitability, and cash flows, for purposes of this segment, we will only focus on the leverage adjustment. So here is an example of a company's footnote disclosure showing their pension and OPEB funding status. On the left-hand side, you see the pension benefits. On the right-hand side, you find the other post-retirement benefits, or the OPEBs. At the very top of the section, you'll find the pension and OPEB obligation section, leading you to the benefit obligations at the end of the year. And the second half of the section deals with those assets which are set aside to meet those obligations. And if you look at the fair value of the planned assets at the end of the year, you see those figures here. What we essentially want to focus in on is the funding status of the plans. It's that number that gives you either the surplus or the deficit as of a particular point in time. Our analytical adjustment simply takes the funding status of both the pension and the OPEB level, so in this case of 3, 5, 2, 6, plus the 1960, and for practical purposes we add those two together to arrive at 5486. We then tax affect that amount, assuming that the company will be able to get a tax benefit when they fund those obligations, and we generally use a 35% incremental tax rate here. And of course that depends on the company's tax status as well as the jurisdictions of the plans that these are in. But assuming it's 35%, we take the 5486 and multiply it by 1 minus the tax rate to arrive at an adjustment of 3565.9. Here we show you the published reconciliation table, which essentially provides transparency into our analytical adjustments. And here you find the 3565 adjustment that was made to the company's reported debt level. As you can see, it represents about 43% of reported debt, providing some perspective as to how meaningful that adjustment truly is. And it's this amount that gets added to reported debt to create a S&P adjusted amount, which gets reflected in all of our debt measures. To summarize, why do we adjust for pensions and OPEBs? Because we treat them as a form of deferred compensation that represents a call on future cash flows of the company. And to the extent these plans are underfunded, we consider them debt-like in our analysis, based upon the same measures that companies record them on their balance sheets.